Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. This one is, I had a little bit of an idea, just kind of hit me, and I thought it would be kind of cool to create a small little series similar to what I do with the candle by candle analysis, but just going full bore technicals, right? So taking a market and then just over analyzing it. And I thought, what a really cool way to just go absolutely ham on analytics. And I know some people just like seeing that happen. It's just seeing the process occur. And I thought it fit really, really well as a cool idea. So going for this kind of concept, if you guys like it, make sure to drop some comments. Let me know if you like this idea. I'm going to go with the name probably Overanalyzed. I feel like that fits really well for the idea of what I'm going to be doing here. Now, as far as what I'm going to be going over, I'm going to start off on the NASDAQ, and I'm just going to start off on a 5-minute chart. And what I'm going to look to do is just literally overanalyze the absolute living crap out of this chart. From the bull's perspective, from the bear's perspective, looking at every single scenario that I can really kind of come across, obviously, as far as working our way forward. So buckle in, because this will be the first time, just kind of a concept idea that I wanted to throw out there. But let's see what kind of fun we can get into. So first off, the thing that I like doing initially is going from left to right. What direction is the trend going? Well, I can see price coming onto the screen here, and at the moment price is here, therefore price is up. That does demonstrate a slight bullish nature. Now, if we look at a little bit of common sense here, realistically, this has not been an easy up. So far along the way, we started actually down, then up, then down, then up, then down, and now potentially where we are now. So the first thing is we're back to that cycle, and my immediate concern is, well, wait a minute. Every time that we've gone back up to the highs, the failures off of the top have been incredible. But, it hasn't been an immediate drop. The moves to the upside have been relatively grindy, and it really worked its way up there. Same with over here. When we broke above the highs, there's a big jerk above, and then it really kind of spent some time up there. As the market was driving to the downside, we can see that it was a V bottom. It didn't spend very much time there, even on the shallower ones. Down here, again, it did churn around a little bit, but it didn't spend a ton of time there. So immediately I'm thinking, well, okay, the last couple times we've broken above the highs, it's been with some serious conviction, and we just recently poked our head above the high. Now, the last time we saw a failure that happened like that was over here. They poked their head above the high, failed down, and they held with a quick little trap underneath the base. Let's look backward at what just happened. We poked above the high, we just trapped a little base. Well, you tell me, right? That looks pretty bullish from this previous kind of information that's showing us, well, wait a minute, the bulls definitely have a case here to continue this drive up. And in fact, on that last one, that was the launching pad for that continuation to the upside. So utilizing those numbers then, if we go from the bottom to the inevitable top up here, that was 0.75%. So if we go from the bottom, let's just say from the little trap low there, going back up, 0.75% puts the market roughly up at 14,915.50. It'll be interesting to see when this video actually launches how that actually played out. But given the way that this is moving to the upside, this has some very, very strong similarities to what has been going on before. Now, taking a step back and looking at this really looked like the bears were trying to get something to go to the downside, like really hammer this thing lower. And this looks like it might have even been the attempted beginning of the first type of Elliott wave, right? You've got wave 1 into 2, big breakdown, wave 3, right? Wave 3 being longer than wave 1 and having potential swing lows underneath. Oh no, wait a minute. We have a problem. All of a sudden it became invalid. So a lot of sellers were likely trying to get this thing to go to the downside for another leg. And if we zoom in just a touch here and look back at the last time from the bottom over here, and we'll work our way forward before it broke up through the next high, we can see that the POC is top weighted, suggesting that sellers were really trying to get this thing to dive down. And they totally failed. So when they totally failed, where did the market come back to? Didn't even give them an actual break even. It was either they accepted a small loss or they didn't get filled and they're going to have to accept a significantly larger loss, at least for the time being. Which brings us to the next point. Did that POC change? Let's bring it a little further forward. Oh, no, it didn't. Uh-oh. So in terms of a major open zone of interest, if the market were to flush back down, that would be a significantly viable spot to try to get back down to, because a lot of those shorts were very obviously trying to get it to go lower. And although they were given a chance to get out at a small loss, there have been no break-evens, at least on this initial POC. Now, if we drag this a little bit further forward, obviously, the market spent a huge amount of time in here, so it very likely created a POC in there. Oh, no. Wow, they didn't. Through all of this, there was no POC change. It actually stayed lower. That is an incredible amount of information. A lot of those traders are still potentially stuck. Let's drag this further forward. Okay, so they did change it right before the rally to the upside at 14,705. And you can see they poked it right there, right before the breakout above the highs, and then finally jumped the market back up. Okay, so they did actually change the POC. If we drag this a little bit further forward, now that we've made another new high, we can see that this 14,705 is still potentially an area of interest. Let's put this into context, right? Because the last POC was right here. Now we have a POC here. If the sellers were looking to get out at break even, where would their break even be? Assuming that they doubled up, right? Which I think is honestly fair to say. This one stopped here, this one stopped here. That is definitively about twice the distance, right? I mean, that's a pretty good distance, maybe about 45-ish%. We'll call it basically doubling down, right? 1-to-1. So noting that that information took place, we've got these two POCs. Where is their break even likely to be? Right around the middle. Well, that's interesting. That's exactly where the market created a double bottom. Have these sellers actually been trapped? Or did they modify their entry and take the smart exit and jump ship at break-evens in the middle? I think realistically speaking, from a common sense standpoint, knowing what's going on, I think a lot of them probably bailed right here, especially given the response. But let's go worst case scenario, right? Let's go all the way up to where we are now, at least at the time of recording this. We have not shifted a POC back up. Pretty important information, because if the market does dive to the downside, that would still demonstrate that those sellers haven't had a chance to get out. We had a POC that was here. They moved their average up to the top. We already know they probably took break-evens between the two. Hush, hush. And now this is their chance to try to rally the market back down, tank the market back down. I don't know, whatever you want to call it, back down to the lows and get their break evens off at 14,705. And that fits a very, very nice structure if we zoom out a little bit in terms of looking for the market to pull back to a zone of interest. Meaning, if we go back, repetition would dictate that we have an L3. L3 on a powerhouse breakout, really strong breakout, probably going to follow through with an L1. This is actually one that we talked about in the chat room in Discord this morning. That was this first pullback off of the top, looking for the first pullback to dip to L1. They got it, went screaming V-bottom all the way up to the highs. Fantastic bounce out of that zone. Now, when the market started creeping its way back up to the highs, we have to assume that we're either going to continue an L1 trend over and over and over and over again, or the market's going to run out of steam and look for a deeper pullback. They broke another high. Here, they couldn't even get back to L1 and then rotated back up to another new high. Incredible strength. But then the next time around, they just got obliterated down through the top of it. And it's almost like buyers like, whoa, wait a minute. Whoa, okay. Hang on. Where is this thing going to close? We've got that initial kind of herky-jerk move. Now they're trying to find some balance. If the bulls are going to continue this support, this is where they're going to want to re-up, mainly because if it breaks down through the lows, this allows them a beautiful risk-reward. This allows them a 2-to-1 back to the upside easily, if not potentially more into the all-time highs. We know how that can go. So the bulls have a potential case here for a continuation up. But at the same time, if we're looking at this from another perspective of an ABCD correction, then we've got this move up to 1-to-1. And this most recent move up, this is 1-to-1, I'll park it right there. That was a 1-to-1 correction back. They poked their head just above it, just to get whack-a-mole back down, and now we're holding it as resistance. That doesn't necessarily mean that the market absolutely has to reverse right now. That's not what this means. But what it would at least say, from the bull's perspective here, is that if I want to be a buyer, it might make more sense to wait for a better pullback. And a better pullback right now, well, we've got an open gap, right? Previous swing gap. That's the highest point to the lowest point the market was able to come down to. That leaves a major upside objective that we'll come back to in a second. But what better spot, if the market doesn't break higher, to buy back into and backfill some of this gapping? Markets love backfilling those gaps right before a big move. And that would fit perfectly with an ABCD to the downside, hit the L2, which is a deeper pullback than we've had going on the upswing. And that would take out a lot of the stops on the lows back into previous value. It would get the bigger POC to the downside. Basically, while all the scribbling aside, this larger pullback makes a ridiculous amount of sense if it shows up. Now, if the market continues to drive higher like we're seeing here with these big blow-offs on the top, this big high, this megaphone top, holy cow, this megaphone top, and we aren't seeing the rotation back down, which I think everybody can agree we should see usually with a megaphone, especially on the NASDAQ, a rotation back down. You can see it without even having to draw it. That would project, again, that downswing. If they fail, a lot of sellers, myself included, would be surprised. Now, if they are short, I'm not short at the moment of recording this, but if sellers were short, then realistically, they're going to be underwater pretty quick, and then we see this thing turn from a megaphone into a bull channel, and it goes screaming all the way back to the upside, and then you can actually see that happening right here, where this would be the bottom. And we're looking for a continuation back up. Where does that put the objective points? It's crazy how everything lines up, isn't it? Just saying, you know, when everything lines up like that. One consideration as well, while we're talking about this, before I forget about it as well, this previous swing gap, the previous high to the previous low. Very similar to candle gapping, like I've talked about before in a previous video. This is swing gapping, just zoomed out. I suppose these could just be one candle. But the market left behind this open gap. And when you have an open gap, that gives us an idea of where it's going to likely want to go. So if we measure from the lowest point to where the gap was actually closed, right? So right there to there. And you could even make it a little bit more narrow if you wanted to stay on the, you know, a bit on the conservative side, I guess, if you will. We'll take this box and we'll double it up. That's the upside objective for traders. Now, it's interesting that this lands basically on top of everything else that we've been talking about. Now, look, just a bit above. What number? What number happens to be up there? 15,000. That is a huge psychological level that could draw the market back and create a massive magnetic point that kind of creates an overblow, an overdrive, massive move up, or what we could consider in Elliott wave theory, at least now that we've got this larger leg, could be the fifth wave. And that would be a very large move up. And if we're looking at that from that perspective, that would give upside objectives where? You can't make this stuff up, right? I mean, it's crazy how many things start lining up when you're looking at all of these different areas. Now, again, I'm super curious. I'm probably going to end up watching my own video back on these to see what did the market do, right? What can we learn from how we analyzed it versus what did the market actually happen? And I think that's where some of the cool value aspects of this are going to go, where next week or in the next video, after there's been a little bit of time, this is a 5-minute chart, so we don't really need a ton of time. But what did the market do? How did it do? How did our analysis do? Did it give us some pretty good heads up in terms of what to expect? And this is kind of the idea, just chasing concepts and ideas down the rabbit hole. Where do I think the market's going to want to go? To the upside, to the downside? We've really kind of analyzed this from the beginning point all the way up to where we are now, and it seems like we're a bit on a confusing side in the middle. What we can look at then, if we're in the middle, what would make a lot of sense? Everything to line up. If everything to line up would make a lot of sense, well, then realistically we have the move down, which would fit that quick little trap underneath the lows, and then the rotation back up. Grab that previous POC that was left behind in the middle of nowhere, get that out of the way, swipe them out, and then go screaming all the way back to the upside. Now, if they do that, let's think a little bit further forward. If that were to occur, this 0.75, that doesn't fit anymore. Things have changed, right? So we're actually going to have to modify this down a little bit further for a double value pullback instead. And that might have to have them chasing this larger move to the upswing. upswing rather. So really, we are on a bit of a tipping point. The market needs to make its decision, and when it does, we'll know exactly what to expect going forward. The important thing right now is that it's right in the middle, and it looks as though if the market wants to go down, we've got some support to get out of the way, and then rotate down to grab that point of interest somewhere around this area. From there, if the market wants to rotate back up, it would make perfect sense to try to go back up, find some resistance on the retest of the channel. From there, they're going to have to make it kind of known, which way do you want to go? All-time highs? Are we going to hit the 15,000? Or are we going to fall apart and just sort of, work our way all the way back down and fill in this gap and kind of finish the job? That'd be a little bit of a bummer. I would like to see this thing continue back up from that fifth wave perspective and see that big old blow off all the way back up into, all the way up to 15,000, potentially even the 15,054. If it really wants to hit the gas pedal, you've got the 1618, which is 15,208, almost 209. So there is a ridiculous amount of potential still left on the table, even though it doesn't feel like it. If the bulls step it up a notch here and kind of, they take a step up to the plate and swing. Let me see how many acronyms I can get in here, or references I can get in here while I'm stumbling over myself to get that move going to the upside. Bulls know that, which means that their risk is likely relatively small. They're not going to risk a whole lot because they're looking for huge objectives. So, with that in mind, the swing traders are still long, and it's still going to the upside. And until we see something change, like a POC change or the dip back to get that break even or something along those lines, then realistically the bulls are still in, and it's more likely to expect this to keep on going. All right. That's going to do it for this one and the whole idea of overanalyzed. I really love the concept of this, and I'm curious to see how you guys feel about it. Don't forget, drop those comments in and let me know. What do you think as far as overanalyzed? The idea, the concept, and something that I really recommend a lot of people do anyway, is going down every analytical rabbit hole that comes across your path. Right? Oh, you got a Fibonacci? Hey, jump down that really quick. While you're looking at the Fibonacci, you notice that there's an Elliott wave. Jump on that one too. Take every avenue that you can. Because what better way to, first off, gauge context? How would you ever understand what's happening in the here and now if you haven't done a little bit of, historical seeing what's going on, looking through the history books, if you will, even if it is only a 5-minute chart. And once you've gone through that, you've got the context. It's just kind of built into the story. But along with that, another part of this is it's great practice. What better way to practice your analytical skills than just using everything that you've ever done, right? Now, be careful, right? You'll notice I'm using a naked chart. I don't even have my normal moving averages on here. I'm forcing my eyes to look at the market only. Now, for me, I do use indicators normally, and I took them off for this one. You don't have to do that, but that is something that I like doing because it forces me to get out of my comfort zone. If I use a MACD, that ends up being a crutch. And now I'm waiting for the MACD signal, and I'm hobbling along, and the MACD signal comes 7 candles late, and now I'm upset and frustrated. We have to get out of our comfort zone and put us in a situation that it gets us back to our roots, right? Really analyzing what are the structures of the market doing. And that's really the whole concept of this overanalyzed idea. Again, let me know what you think about it in the comments below. But aside from that, I hope you had a great trading day. And until the next one, we'll see y'all then. All right. Have a good one. We'll talk to y'all later. Thanks.